Welcome back to the deep dive. Today, we are focusing on DuPont de Nemours, or DD. This is a massive company that's been, well, fundamentally reshaped over the last few
It
years.
really has.
So we want you to forget the old school chemicals image because this deep dive is really a masterclass in corporate architecture.
Right. It's about how a sprawling conglomerate tries to dismantle itself to unlock potentially billions in hidden value.
So this is more than just a simple restructuring.
Oh, absolutely. It's a deliberate, high-stakes surgery. For too long, the market has applied what we call the conglomerate discount.
Okay, what does that mean exactly?
It means treating DuPont's high-tech, high-growth engines the same way it values its stable, but much slower legacy assets. They're all just lumped together.
And our mission today is to see if this dismantling, the strategic separation, is actually going to create that valuation arbitrage everyone is hoping for.
Is the sum of the parts really worth so much more than the whole?
That's the question.
It is. And we need to dissect the competitive moats of the two entities that will emerge from this.
And crucially, we have to look at the risks.
Immense risks. Everything from huge legal liabilities to, geopolitical headwinds that could derail the whole thing before that November 2025 target.
Okay, so let's unpack this structural transformation. We're talking about the planned separation of the electronics business.
The high growth part.
Right. That will be spun off and named Qnity.
And then the world-class water business remains as the anchor of the other entity, New DuPont.
So why is this separation the catalyst?
Because it forces the market to re-rate the stock. The current entity, it trades near diversified chemical multiples.
So what, maybe 8 to 10 times EBITDA?
Exactly. But once they're separated, investors can finally apply the right multiples to the right businesses.
Let's talk about those target multiples then. Why are they so much higher?
Well, the businesses are just fundamentally different. Qnity aligns with semiconductor and high-tech material peers.
So investors will pay more for that.
They'll pay a lot more. You're looking at multiples of, say, 14x to 18x EBITDA for that kind of innovation.
And what about New DuPont?
New DuPont, anchored by that water business, is a pure infrastructure play. It aligns with stable utilities, ESG mandates.
Which also get a premium.
A huge premium, sometimes pushing 15x to 20x EBITDA. It's a scarcity value.
So the discount is just the market mixing these two really desirable segments together with slower parts.
Yes.
I saw Deutsche Bank estimate that this split alone could realize a target value of around $126 a share.
That's the number people are looking at.
I mean, that's a potential upside of nearly 38%.
It is, and is a powerful, powerful incentive for management to execute this thing perfectly.
And a lot of that promise really hinges on the performance of Qnity, right? The growth engine.
It does. Let's dive into that segment first.
Okay, Qnity is where the high margin action is. We saw their EBITDA margins hitting over 30% in Q4 2024. What makes this business so resilient?
It's two things. Mission criticality combined with massive switching costs.
Okay, break that down. Mission criticality.
Their materials are often a tiny, tiny percentage of the cost of a final chip. Maybe 0.5%.
Negligible.
But if those materials fail, the entire advanced manufacturing process fails. That risk aversion is their moat.
And I'm guessing the AI boom is only making their niche more valuable. We focus on the GPU, but you're saying the bottleneck is shifting.
Absolutely. The bottleneck is now interconnect density.
Not the transistor.
No. As you link hundreds of chips together for an AI cluster, the challenge is moving data between them reliably and incredibly fast. Qnity's chemistries are, in essence, the high-speed fiber optic network that's built inside the chip package.
So they're the critical plumbing for things like CoWoS that advanced packaging TSMC uses. How does that translate into pricing power?
It's the lock-in factor. Once a material is qualified and integrated into the process of record, or POR.
The blueprint for the factory.
The multi-year manufacturing blueprint, yes. It's almost impossible to remove. That qualification process alone can take 12 to 24 months.
So fabricators just won't risk it.
They will not risk crashing their billion-dollar yield lines to save a fraction of a penny on a new supplier. It's just not worth it.
And that creates this powerful winner-take-most dynamic.
Right. And it allows them to push through selective price increases, sometimes up to 10% on really specialized products.
Wow.
And beyond silicon, you have to look at Kapton polyimide films. This is the invisible backbone of modern high-performance electronics.
Like in aerospace or smartphones?
Aerospace, high-end smartphones, and critically EV battery management systems. They don't compete on volume, they compete on survival in extreme environments.
Can you give us a specific example of that extreme engineering?
Sure. Take EV motors. The industry is rapidly moving to 800-volt architectures.
For faster charging.
But that higher voltage dramatically increases the risk of something called corona discharge.
Electrical arcing.
Exactly. It destroys standard insulation, leads to premature motor failure.
Right.
The Kapton FCRC variant is specifically engineered to resist this. It makes it indispensable for these new platforms. They are selling reliability, not just a plastic film.
That is a deep, powerful moat. But you mentioned something called the Red Queen effect.
I did.
So even with these amazing products, they can't afford to rest?
That's the reality of the semiconductor supply chain. You have to innovate, constantly moving from 5-nanometer nodes to 2-nanometer nodes just to maintain your current position. If you stop running, your moat erodes fast.
And that innovation cycle makes their revenue pretty lumpy, right? It reflects the broader industry CapEx trends.
We're seeing that play out right now. TSMC is ramping up like crazy for AI, so that's driving huge demand in Asia-Pacific. I think Q4 2024 organic growth there was 11%.
But not in North America.
No. North American spending, especially from Intel and Micron, is contracting. Project delays. That meant only 1% growth in EMEA. Qnity investors have to be comfortable with that Asia-skewed cyclical profile.
Okay, let's transition to the other half of the puzzle here. New DuPont. The decision to keep the water business seems to fundamentally strengthen the whole thing.
It absolutely does. It gives new DuPont a critical anchor of secular stability.
Tell me about that.
Well, the water solutions segment, centered on the FilmTec brand, is arguably one of the highest quality infrastructure assets in the entire portfolio. They are the global leader in reverse osmosis membranes.
And the business model is that razor and blade structure.
It's a fantastic model.
So explain that in the context of, say, a huge desalination plant.
Okay, so a city or a factory spends hundreds of millions designing a plant around the specific dimensions and chemistry of a FilmTec element.
They're locked in.
They are captive. When those membranes predictably wear out, they have to buy the replacement blades from FilmTec. It is highly predictable, high-margin, recurring revenue.
So the moat isn't just the brand name, it's the total cost of ownership, the TCO.
Precisely. Energy is the single largest operating expense for any desalination facility.
I didn't know that.
Oh, yeah. And FilmTec's competitive advantage is efficiency. Their BW30 PRO 400 elements can reduce energy consumption by up to 20% compared to older ones.
Which over the life of a plant is a massive saving.
It's monumental. It far outweighs the initial cost of the membrane. That's why they can command such a premium.
And they've also been very strategic about de-risking this, right? The local for local approach.
Absolutely. The acquisition of Cenicum's RO membrane business in China was just genius.
Oh, so?
It gives them supply chain resilience, it lets them avoid potential tariffs, and it also lets them capture the massive mid-tier domestic Chinese market with a local brand.
While keeping the premium FilmTec for the high-end stuff.
Exactly. It's brilliant market segmentation.
Now, new DuPont also keeps the protection portfolio, including Tyvek. But this high-margin asset has its own geopolitical headaches.
It does. Tyvek is dominant in everything from construction wrap to sterile medical packaging. It's a cash cow. But it's currently under investigation by China's state administration for market regulation. They're looking into alleged antitrust violations, market dominance.
What's the real implication if China decides to pursue this?
It's a severe regulatory headwind. This isn't just a fine. If Beijing determines they have a monopoly, they could force price caps, maybe even mandate technology sharing.
They go break up the distribution network.
Right. And given the rising trade friction, this probe is a very real high-stakes risk to one of new DuPont's most profitable products.
Let's talk about the people managing this huge transformation, the Ed Breen School of Management philosophy. What does that look like with Lori Koch as the new CEO?
It's all about rigorous capital allocation and portfolio simplification. Koch moving up from CFO, that signals an execution-first mandate.
So the board wants financial discipline.
Discipline and ensuring this spinoff is done smoothly and cost-effectively, not rushed.
And you can see that in how they incentivize the leadership team.
Yep. You absolutely can. Executive compensation is tightly linked to performance-based equity. The key metric is adjusted return on invested capital, or ROIC.
Why adjusted?
The adjusted part is crucial mid-restructuring. It lets you track how well management is generating returns specifically from the assets they choose to keep. It discourages just, growth for growth's sake.
And they have to hold a lot of stock, right? Real skin in the game.
The CEO has to hold 6 times their base salary in equity. Their fate is entirely aligned with shareholders.
And they're backing that conviction up right now with shareholder action, that aggressive $2 billion share buyback.
Including a $500 million accelerated repurchase, yeah.
Executed before the spinoff.
Yeah.
That's management signaling very clearly that they think the stock is undervalued today.
It's a huge vote of confidence. And this discipline, it's showing up in the results. Look at the divergence.
Okay.
They reported, a modest 3% top-line sales growth in FY 2024?
Right.
But their adjusted EPS growth was a much stronger 17%.
Wow, that's a big gap.
That gap shows that as volumes slowly return, they're capturing substantial operating leverage from margin expansion, especially in that recovering electronics segment.
Okay, let's talk about the one factor that causes the most uncertainty, the red team challenge.
The elephant in the room.
PFAS litigation. This is the single biggest tail risk.
It is. Now, they have made progress. They settled major claims related to public water systems for about $1.2 billion.
But the fight is shifting.
The legal battlefield is shifting to 2 much more dangerous areas: upstream liability and personal injury.
Explain that shift to upstream liability. What does that mean?
Well, there was a case, Baker et al., VEI DuPont, that validated a terrifying precedent.
Which was?
The theory that a raw material supplier can be held liable for contamination caused by a downstream user of their product.
Even if DuPont didn't directly control that user.
Exactly. If that theory gains more traction, their liability shield becomes very, very thin.
And the current settlements don't even cover the thousands of personal injury claims, cancer clusters, things like that.
Correct.
Now, I know they establish a cost-sharing cap with Chemours and Corteva. How solid is that $4 billion cap?
It's a cap on shared liability for specific claims.
Yeah.
It's not an absolute cap on their total exposure.
So there's a snapback risk.
That is the perfect term for it. If the judgments for those 9,000-plus pending personal injury cases exceed that $4 billion shared limit,
The burden snaps back directly onto their balance sheet.
potentially uncapped future exposure. The market is pricing in this uncertainty for a very good reason.
That is a huge shadow hanging over this whole deal. And on top of that, there's just plain execution risk. You call it dyssynergies.
Right. When you break up a complex organization, you risk temporary earnings compression. The corporate overhead, legal, IT, accounting,
Yeah.
that was spread across the massive old DuPont.
Now has to be absorbed by 2 smaller companies.
Exactly. New DuPont, especially, will be under immense pressure to cut its SG&A costs quickly to prevent that margin deterioration right after the spin.
So we have the core tension summarized. The bull case relies on perfect execution. Qnity getting that high AI-driven multiple of, say, 16x EBITDA, water getting a scarcity multiple of 14x, and that gets us toward that $126 target.
And the bear case sees a semiconductor correction hitting Qnity, a housing stall hurting Tyvek, the Chinese antitrust probe turning into a major revenue hit.
And most critically,
A bellwether PFAS judgment that breaches the $4 billion cap and triggers that severe snapback liability.
so this investment is really a combination play. It's a call option on the AI supply chain's future, coupled with a fundamental safety play on global water infrastructure.
Both of which are currently bundled inside a shell that the market has discounted because of these legacy issues.
Right.
Look, the legal risks are known, but they're also increasingly quantified. So the question isn't whether the liability is serious. We know it is.
The real question is,
It's whether those inherent technical winner-take-most moats in their specialized materials, those high-speed interconnects, those low-energy RO membranes, are strong enough to absorb a known but substantial cost over the next decade.
so here's a final provocative thought for you to consider. Since the market is clearly pricing in maximum uncertainty on the legal and geopolitical risks, maybe the biggest opportunity is hiding in plain sight.
Go on.
You should investigate what valuation multiples specialized pure-play electronics suppliers are trading at right now in the private markets or in specialized tech funds.
I see where you're going with this.
Are those investors already valuing the future Qnity at a much higher multiple than the discount applied to the current DuPont structure? If they are, the undervaluation could be even more significant than $126.
Always look beyond the headlines.
We'll catch you on the next deep dive.